The complete story of the most influential accelerator in Silicon Valley. The story of Y Combinator. March 2005. A small office in Cambridge, Massachusetts. The dot-com bubble has burst 5 years earlier. Sand Hill Road venture capitalists are still nursing their wounds from the crash. The conventional wisdom is clear. Early-stage investing is dead. Too risky. Too expensive. Too time-consuming. Professional investors need at least $500,000 to $1 million minimum check size to make the economics work. Into this moment walks Paul Graham, a 40-year-old programmer and essayist, with an idea that everyone thinks is crazy. He's going to invest tiny amounts of money, as little as $6,000, in groups of startups simultaneously. He'll bring them all together for 3 months, work with them intensively, then present them to investors on a single day. He's calling it Y Combinator, named after a concept from computer science. A function that operates on other functions. The idea violates every rule of venture capital. The checks are too small. The time frame is too short. The batch model seems absurd. How can you possibly give meaningful help to 10 or 20 companies at once when traditional VCs struggle to add value to 8 portfolio companies? How can anyone evaluate a startup in 3 months when proper due diligence takes 6 to 9 months? And who are these founders he's backing? College kids. Teenagers in some cases. Companies that are literally just ideas written on napkins. But Graham sees something others don't. He sees that the cost of starting a technology company has collapsed. You don't need $1 million for servers anymore. You can start a web company for a few $1,000s now. Amazon Web Services will launch later this year, making infrastructure even cheaper. Open source software is free. The barriers have crumbled, but the venture capital industry hasn't adjusted. There's a massive gap between what startups need and what venture capital provides. More importantly, Graham has a thesis about founders that comes from personal experience. He knows what it's like to start a company as a technical person with no business training. He sold his startup via web to Yahoo for $49 million in 1998. He remembers how clueless he was. How much he had to learn. How many mistakes he made that could have been avoided with just a little guidance. He thinks the most valuable thing he can provide isn't money. It's knowledge. Pattern recognition. The ability to say we've seen this before, here's what usually works. But here's what really makes Y Combinator different. Graham has spent the past 5 years writing essays about startups and programming that have become cult reading in the technology community. He has built an audience. A reputation. A brand based on understanding what actually matters in early-stage companies. When he announces Y Combinator, he's not some unknown person trying to raise a fund. He's Paul Graham. People trust him. They read his essays. They believe he understands something important about how great companies get built. The first Y Combinator batch starts in summer 2005 with 8 startups. The investment is $6,000 plus $3,000 per founder. For this, Y Combinator takes 6% of the company. The deal is simple. Come to Cambridge for the summer. Work intensely on your startup. Meet with Paul and his partners Jessica Livingston, Robert Morris, and Trevor Blackwell once a week. At the end, you'll pitch to a room full of investors on demo day. That first batch includes a company called Reddit, started by Steve Huffman and Alexis Ohanian, 2 22-year-old recent University of Virginia graduates. Their idea is simple but ambitious. The front page of the internet. A place where users submit and vote on links. The best content rises to the top through democratic voting. They'll build it in 3 months using a programming language Graham invented called Arc. Also in that first batch is Loopt, a location-based social network started by Sam Altman, a 19-year-old Stanford dropout. Loopt wants to let people see where their friends are in real time on their mobile phones. The iPhone doesn't exist yet. Mobile apps as we know them don't exist. But Altman is betting that mobile social networking will be huge. He's intense, ambitious, and phenomenally productive. Graham sees something special in him immediately. The batch model seems chaotic at first. 8 companies all working in the same space. Weekly dinners where founders share problems and solutions. Constant informal interaction. But something unexpected happens. The founders help each other. When one company figures out how to handle a technical problem, they share the solution. When someone discovers that a certain investor is difficult to work with, word spreads instantly. The collective intelligence of the group exceeds what any individual company could achieve alone. This is the first hint of Y Combinator's secret weapon. It's not the money. $6,000 barely matters. It's not even the advice from Paul and his partners, though that's valuable. It's the peer network. The batch structure creates a support system and knowledge-sharing platform that compounds over time. Every batch adds to the collective wisdom. Every founder who goes through Y Combinator becomes part of a growing network that helps future batches. Demo Day in August 2005 is held in the Harvard Faculty Club. About 15 investors show up. The startups present for 2.5 minutes each. It's informal, almost amateurish compared to the polished presentations that venture capitalists are used to. But something about it works. Several companies get funded. Reddit raises $500,000 from Paul Graham, Steve Huffman's old roommate, and a few angels. Loopt raises $500,000. By venture capital standards, these are tiny rounds. But they're enough. The companies are launched. What happens next surprises everyone, including Graham. Reddit grows quickly. Within months, it's one of the most visited websites in the world. The community dynamics work brilliantly. Users become addicted to voting and commenting. The site's traffic grows exponentially. In October 2006, just 16 months after starting in Y Combinator, Reddit is acquired by Condé Nast for between $10 and $20 million. The exact number is never disclosed. For Y Combinator, this is validation. They invested about $12,000 for 6% of Reddit. That 6% is now worth somewhere between $600,000 and $1.2 million. That's a 50 to 100 times return in 16 months. And more importantly, it proves the model works. You can find talented technical founders early, give them minimal capital and intensive support, and create significant value quickly. The second batch in winter 2006 has 8 companies. The summer 2006 batch has 18. Word is spreading. Applications are increasing. More investors are showing up to Demo Day. The Y Combinator brand is strengthening. Something else is happening too. The alumni network is activating. Reddit's founders are advising new batches. They're introducing companies to investors and customers. They're hiring people from other Y Combinator companies. The network effects are beginning to compound. But Y Combinator is still tiny and precarious in 2006. Paul Graham is funding it mostly from his own money. The partners work for free or nearly free. There's no formal fund structure. No limited partners. No management fees. It's more like an experiment than a business. If a few more companies succeed, it might become sustainable. If not, it'll fade away as an interesting but failed experiment. Then in summer 2007, something happens that changes everything. 2 24-year-old Stanford computer science students named Drew Houston and Arosh Ferdowsi apply to Y Combinator with an idea for making file syncing and sharing simple. They call it Dropbox. The problem they're solving is one every computer user experiences. How do you access your files from multiple devices? Email attachments are clumsy. USB drives get lost. Existing solutions are complex and unreliable. Houston has the idea after forgetting his USB drive on a bus ride from Boston to New York. He starts coding a prototype during the bus ride. The technical challenge is significant. Files need to sync seamlessly across devices. Conflicts need to resolve gracefully. It needs to work on Windows, Mac, and Linux. And it needs to be invisible to users. They should never think about syncing. It should just work. Graham is immediately excited about Dropbox. He uses computers extensively. He feels the pain they're solving. He can imagine everyone using this. But what really impresses him is Houston. The founder has the right combination of technical brilliance and user empathy. He's solving a problem he experiences personally. He's thought deeply about why existing solutions fail. And he's capable of building something better. Y Combinator invests $12,000 for 6%. Dropbox enters the summer 2007 batch. Houston and Ferdowsi move to the Bay Area. They work obsessively on the product. They talk to users constantly. They iterate rapidly based on feedback. By demo day, they have a working prototype that genuinely solves the problem better than anything else available. The demo day presentation is brilliant. Houston shows a video of Dropbox working. Files syncing magically across devices. Photos appearing instantly on multiple computers. Documents updating in real time. The demo is only 2.5 minutes, but it perfectly communicates what Dropbox does and why it matters. Investors crowd around Houston after the presentation. Everyone wants in. Dropbox raises $1.2 million from Sequoia Capital, Y Combinator, and several angel investors. The valuation is $4 million. This seems reasonable at the time. It will turn out to be one of the great venture capital investments of all time. Dropbox grows explosively. The product is so useful and the experience so seamless that growth is mostly organic. People use it, love it, and tell their friends. The waiting list grows to hundreds of thousands of people. By 2008, Dropbox has millions of users. By 2011, they have 50 million users. The company raises round after round at escalating valuations. In 2014, they're valued at $10 billion. Y Combinator's 6% stake is worth $600 million. That's a 50,000 times return on $12,000. Even after dilution, it's the kind of return that defines a venture capital firm's entire reputation. But Dropbox isn't just a financial success for Y Combinator. It proves something more fundamental about their model. The best startups often come from technical founders solving problems they experience personally. These founders don't need much money. They need guidance, support, and connections. If you can identify them early and help them avoid common mistakes, you can generate extraordinary returns on tiny initial investments. More importantly, Dropbox validates Y Combinator's approach to demo day. The 2.5-minute presentation format forces founders to clarify their thinking. They can't hide behind jargon or complexity. They have to explain simply and clearly what they do and why it matters. This discipline of clear communication becomes a competitive advantage. Y Combinator founders get good at explaining their companies. This helps them raise money, recruit employees, and acquire customers. The success of Reddit and Dropbox transforms Y Combinator from an experiment to an institution. Applications explode. The winter 2008 batch has 44 companies. The summer 2008 batch has 43. Y Combinator is now accepting less than 5% of applicants. Getting into Y Combinator is becoming as selective as getting into Harvard or Stanford. The partners start to systematize what they've learned. Paul Graham continues writing essays that codify Y Combinator's philosophy. One essay called "Do Things That Don't Scale" becomes particularly influential. Graham argues that early-stage startups should do whatever it takes to make early customers happy, even if those tactics won't scale. Airbnb's founders photographed apartments themselves. Stripe's founders manually integrated their first customers. These unscalable early actions build momentum and teach founders what customers really want. Another essay called "Frighteningly Ambitious Startup Ideas" encourages founders to tackle massive problems rather than playing it safe. Graham argues that big problems are often easier than small ones because there's less competition. Most people are scared of truly ambitious ideas. This creates opportunity for founders brave enough to pursue them. This essay influences a generation of founders to think bigger. The Y Combinator model is also evolving. In 2008, they move operations from Cambridge to Mountain View, California, to be closer to Silicon Valley's investor and talent base. They start organizing formal office hours where each company meets with partners weekly. They create a standardized curriculum covering common startup challenges. They invite successful founders and investors to speak at weekly dinners. They're building infrastructure to systematically transfer knowledge to each batch. One innovation proves particularly powerful. They start inviting alumni from previous batches to help current batches. Reddit's founders advise new social media startups. Dropbox founders help with infrastructure challenges. This creates a culture of paying it forward. Y Combinator alumni feel obligated to help because they were helped. The network strengthens with each batch as more alumni become resources for future founders. In 2009, Y Combinator backs a company that will become even more successful than Dropbox. It's called Airbnb. The story of how Airbnb got into Y Combinator and how Y Combinator helped them survive and thrive reveals everything about what makes Y Combinator different from traditional venture capital. Airbnb is started in 2007 by Brian Chesky, Joe Gebbia, and Nathan Blekeksik in San Francisco. Chesky and Gebbia are roommates struggling to pay rent. They have an idea. A design conference is coming to San Francisco and all the hotels are booked. What if they rent out air mattresses in their apartment to conference attendees? They create a simple website called Air Bed and Breakfast. They get 3 customers who pay $80 each. The idea works, but it's not clear if it's a real business or just a one-time hustle. They apply to Y Combinator in early 2009. Paul Graham is skeptical. Renting air mattresses in strangers' apartments sounds crazy. Who would do this? It seems more like a lifestyle business for broke roommates than a venture-scale opportunity. But Graham agrees to meet them. In the meeting, Chesky shows him cereal boxes they created called Obama O's and Cap N McCain's during the 2008 presidential election. They sold them for $40 a box and made $30,000. Graham is impressed by their resourcefulness. These guys will do whatever it takes to survive. That's important. Graham accepts Airbnb into the winter 2009 batch. Y Combinator invests $20,000 for 6%. Airbnb moves to Mountain View for 3 months. Things are not going well. Growth is flat. They have revenue of about $200 a week. Most users are listing apartments, but nobody is booking them. The site has quality problems. Many of the apartment photos are terrible, taken with camera phones in bad lighting. The whole thing looks sketchy and unprofessional. In their weekly office hours meeting, Graham asks Chesky where their users are. Chesky says New York. Graham asks a simple question that changes everything. Where are you? Chesky says Mountain View. Graham responds, then why are you here? Go to New York. Go meet your users. See what's wrong. This violates the conventional startup wisdom that you should stay in Silicon Valley to be close to investors. But Graham understands something important. At this stage, users matter more than investors. Chesky and Gebbia fly to New York. They visit everyone who has listed an apartment on Airbnb. They discover the problem immediately. The photos are horrible. Nobody wants to book an apartment when the photos look like crime scenes. So Chesky and Gebbia do something that doesn't scale. They borrow a camera and spend weeks photographing apartments themselves. They help hosts write better descriptions. They coach them on how to be welcoming. They manually improve every listing in New York. The results are immediate. Bookings in New York double. Then double again. Revenue starts growing. The founders have discovered something crucial. Their marketplace has a quality problem, not a demand problem. People want to book unique places to stay. They just need confidence that the places are real and good. High-quality photos create that confidence. This insight becomes core to Airbnb's strategy. They eventually hire professional photographers in every city to photograph listings for free. But even with growth improving, Airbnb faces a bigger problem. They're running out of money. By demo day in March 2009, they have only months of runway left. The financial crisis is at its worst. The economy is in free fall. Venture capitalists are terrified and not investing. Airbnb's business model, which depends on people trusting strangers and spending money on travel, seems particularly vulnerable in a recession. Multiple investors tell them the timing is terrible. Nobody will rent their homes to strangers during a recession. The idea is dead. Demo day 2009 is grim. Investors are scarce. The few who show up are pessimistic. Airbnb's presentation doesn't generate much interest. They talk to many investors over the following weeks. Almost everyone passes. The rejections all sound similar. It's a cool idea, but the market is too small. It's a nice lifestyle business but not venture scale. We don't see how this gets big enough. One conversation is particularly memorable. A prominent venture capitalist tells them, "I'm not sure you want to be in the business of renting out air mattresses on the floor to strangers. That's not a huge market." Chesky tries to explain that air mattresses are just the beginning. The vision is to let people monetize their unused space. Every spare room, every empty apartment, eventually every couch. The market is everyone who has space and everyone who needs a place to stay. The VC doesn't get it. He passes. Airbnb is now desperate. They're about to shut down. They have one last idea. They go back to Paul Graham and ask if Y Combinator will invest more money to keep them alive. Graham does something unusual. He calls Sequoia Capital's Greg McAdoo and tells him he needs to look at Airbnb. Graham rarely makes direct recommendations like this. McAdoo agrees to meet with Airbnb. He likes what he sees. Sequoia invests $600,000 at a $5 million valuation in April 2009. This investment saves Airbnb. They use the money to improve the product, hire engineers, and expand to more cities. Growth accelerates. More importantly, having Sequoia's backing gives them credibility with other investors and the press. They raise more money at increasing valuations. The company grows explosively over the next few years. By 2011, they're in thousands of cities globally. By 2015, they're valued at $25 billion. In 2020, Airbnb goes public at a valuation of $100 billion. Y Combinator's 6% stake, which cost $20,000, is worth $6 billion. That's a 300,000 times return. It's one of the greatest venture capital investments ever made. But more than the financial return, Airbnb validates everything Y Combinator believes about early-stage investing. Airbnb proves that the best ideas often sound bad initially. Renting air mattresses to strangers sounded crazy to almost everyone. It took belief in the founders' resourcefulness and vision to see past the immediate absurdity to the eventual massive market. It proves that founders need help most when things aren't working. Y Combinator's advice to go to New York and meet users personally was simple but crucial. It changed Airbnb's trajectory. And it proves that great companies can start during recessions. Some of the best companies are founded when times are hard because there's less competition and more hunger. The Airbnb story becomes part of Y Combinator lore. It's told to every new batch as an example of persistence and resourcefulness. The cereal box story becomes legendary. The fact that Graham took a chance on them when everyone else passed becomes evidence that Y Combinator sees things others miss. And the $6 billion return from $20,000 becomes proof that betting on exceptional founders with tiny amounts of capital early can generate returns that exceed anything achievable with traditional venture capital. By 2010, Y Combinator is no longer an experiment. It's the most prestigious early-stage investor in Silicon Valley. Getting accepted into Y Combinator is seen as validation that your startup has potential. Demo Day is the most important event in the early-stage funding calendar. Hundreds of investors attend. Companies routinely raise millions of dollars based on demo day presentations. The batch sizes continue growing. The summer 2010 batch has 46 companies. By 2011, batches have grown to 60+ companies. Y Combinator is now seeing thousands of applications per batch. The acceptance rate drops below 3%. They're selecting from a massive pool of global talent. This gives them first look at many of the best founders in the world. Paul Graham realizes they need to scale the operation beyond his personal capacity. In 2010, he brings in partners with different expertise to help evaluate companies and advise founders. Sam Altman, the founder of Loopt from the first Y Combinator batch, becomes a part-time partner. Harj Taggar, founder of Optimatic from the winter 2007 batch, joins full-time. They start adding more partners from successful Y Combinator alumni. This decision to bring in alumni as partners turns out to be crucial. These partners have lived through Y Combinator themselves. They know what founders are experiencing. They have credibility that external partners wouldn't have. They understand Y Combinator's culture and values deeply. And they're personally invested in maintaining Y Combinator's reputation because it reflects on their own success. The partner selection process also reveals Y Combinator's values. They don't recruit famous investors or executives. They promote from within. The partners are almost all former Y Combinator founders who built successful companies. This creates a culture where success comes from operating experience, not just investing credentials. Partners can say, "We've been where you are and this is what worked for us." That resonance is powerful. In 2011, Y Combinator makes another crucial innovation. They start funding companies that apply outside the regular batch cycle through a program called Y Combinator Fellowship, later renamed Y Combinator Continuity. This allows them to invest in companies that aren't ready for a full batch or that need money between batches. It expands their reach and prevents good companies from slipping away because of timing. They also start providing more support post-demo day. The 3-month batch creates intense bonding and learning, but then founders are on their own. Y Combinator begins organizing alumni events, creating online forums for alumni to connect, and offering ongoing advice to portfolio companies. The goal is to make Y Combinator a lifelong resource, not just a 3-month boot camp. The strategy of building a permanent founder community pays enormous dividends. Y Combinator founders hire each other, partner with each other, invest in each other, and advise each other. These relationships create value that compounds over time. A founder who struggled with a technical problem in 2012 helps a founder facing the same issue in 2017. A company that figured out international expansion shares their playbook with newer companies. The collective knowledge grows with each batch. By 2012, Y Combinator has backed over 500 companies. The portfolio includes Reddit, Dropbox, Airbnb, Stripe, Instacart, Coinbase, and dozens of other companies worth hundreds of millions or billions of dollars. The combined valuation of Y Combinator companies exceeds $100 billion. The tiny investments of $10,000 to $20,000 have generated returns that rival the best venture capital firms despite being made 5 to 7 years earlier in companies' life cycles. This success raises an important question. What is Y Combinator's real secret? Why can they consistently identify great founders and companies so early when most investors can't? The answer lies in several interconnected advantages they've built over time. First, they have unmatched deal flow. Because Y Combinator has become the most prestigious early-stage program, the best founders apply. They see thousands of applications per batch from teams all over the world. This gives them massive selection advantage. They're not choosing from whoever happens to walk through the door. They're selecting the top 2 or 3% from a global applicant pool. This is the same advantage Harvard has. Because everyone wants to go there, they can be extremely selective, which maintains their prestige, which makes everyone want to go there. It's a self-reinforcing cycle. Second, they've developed systematic evaluation frameworks that identify founder quality better than traditional due diligence. Paul Graham's essays codify much of this thinking. They look for founders with deep insight into their users, ability to build products quickly, determination that borders on stubbornness, flexibility to pivot when needed, and communication skills to recruit and inspire. These qualities predict success better than pedigree or business plan quality. The application process itself reveals these qualities. Y Combinator's application includes questions designed to surface interesting thinking. What have you built? What's most impressive thing about each founder? Which of the founders knows the most about users? What's an unscalable thing you'll do to get initial users? These questions can't be gamed with polished answers. They require genuine insight and self-awareness. The interview process goes deeper. Y Combinator interviews are famous for being intense and sometimes uncomfortable. Partners ask hard questions and challenge founders' assumptions. They're testing how founders respond to pressure and criticism. Can they defend their ideas while remaining open to feedback? Do they get defensive or do they engage intellectually? These dynamics predict how founders will handle the stress of building a company. Third, Y Combinator has built proprietary pattern recognition that improves with every batch. Each batch is an experiment that generates data about what works and what doesn't. They see hundreds of companies at similar stages facing similar challenges. They can identify patterns that individual investors, who might see one or two companies at each stage, cannot. They know which early metrics correlate with later success. They know which founder characteristics predict ability to recruit teams. They know which pivots tend to work and which don't. This pattern recognition creates a compounding advantage. Every batch makes their future evaluations more accurate. It's similar to how DeepMind's AlphaGo got better by playing thousands of games. Y Combinator's evaluations improve by seeing thousands of startups. By 2015, they've worked with over 1,000 companies. That's more early-stage experience than almost any other investor has. Fourth, the batch model creates value through peer effects that individual investments cannot capture. When founders struggle with similar problems simultaneously, they help each other. When one company figures out how to hire engineers in a competitive market, that knowledge spreads to the entire batch within days. The weekly dinners where founders share problems and solutions create collective intelligence that exceeds any individual company's capacity. This peer learning also keeps founders motivated. Building a startup is psychologically grueling. Most of the time, things aren't working. Having 30 or 40 other founders going through the same struggles creates solidarity. Founders don't feel alone. They see others facing similar challenges and surviving. This emotional support is underrated but crucial. Many founders credit their batchmates with keeping them going during dark moments. Fifth, Y Combinator has built the most valuable alumni network in early-stage investing. Every successful Y Combinator company becomes a resource for future batches. Dropbox founders advise infrastructure companies. Airbnb's founders help marketplace startups. Stripe's founders share lessons about building developer tools. This creates a knowledge base that grows with each cohort. New founders benefit from decades of accumulated wisdom. The alumni network also provides tangible business value. Y Combinator companies do business with each other preferentially. Stripe processes payments for hundreds of Y Combinator companies. Segment provides analytics for Y Combinator startups. Clarkey handles legal formation. These relationships give Y Combinator companies advantages in customer acquisition and partnership. They can call another Y Combinator founder and get a meeting that would take weeks to arrange through normal channels. Sixth, Y Combinator's brand has become a signal of quality that creates advantages in fundraising, hiring, and business development. When founders say they're in Y Combinator, investors take them seriously. Customers trust them more. Engineers are more willing to join. The brand works like a top university credential. It doesn't guarantee success, but it opens doors. This signaling value makes Y Combinator's offer more valuable than just the money they invest. The Demo Day platform amplifies this brand advantage. Y Combinator Demo Days are now legendary events. Hundreds of investors attend. The format, with 2.5-minute presentations from 40 to 80 companies in one day, creates urgency and competition. Investors fear missing out. They make quick decisions and offer favorable terms. This benefits founders enormously. Companies routinely raise $2 to $5 million within weeks of demo day at valuations that would have taken months to achieve without Y Combinator's platform. 7th, Y Combinator has developed operational expertise that helps founders avoid common mistakes. They've seen thousands of companies make the same errors. They know which ones are fatal and which ones don't matter. This allows them to give advice with conviction. When Paul Graham tells founders to focus on product and users rather than fundraising and press, he's speaking from pattern recognition across hundreds of companies, not theoretical principles. This operational knowledge extends to tactical details. How to structure founder equity splits. How to allocate options pools. How to fire underperforming employees quickly. How to run effective board meetings. How to manage investor updates. These aren't glamorous topics, but getting them wrong can destroy companies. Y Combinator helps founders handle these operational issues competently so they can focus on building products. 8. Y Combinator has structural advantages that traditional venture capital lacks. They don't need to deploy large amounts of capital to generate returns. Their fund economics work with tiny initial investments because they get ownership so early. This allows them to make many more bets than traditional VCs. They can invest in companies that are too early or too small for Sand Hill Road. This gives them access to opportunities others can't pursue. The batch model also creates efficiency that individual investments don't have. Instead of spending months on due diligence for each company, they evaluate hundreds of companies in a compressed period, invest in 40 to 60 simultaneously, and work with them as a group. This is far more time efficient than traditional venture capital's serial model. One partner can effectively support 10 to 15 companies in a batch because much of the support happens through group activities like dinners and office hours. 9th, Y Combinator has time horizon advantages that align with the realities of startup building. They invest when companies are just ideas. They own equity that has 7 to 10 plus year time horizons. They're not pressured to show quick wins. This patient capital allows companies to build properly rather than forcing premature scale or exits. Companies like Airbnb, Stripe, and Coinbase took many years to reach their full potential. Y Combinator's structure allowed them that time. Finally, Y Combinator has cultural advantages rooted in their origins. Paul Graham was a programmer and founder first, investor second. This gives Y Combinator credibility with technical founders that pure investors lack. Y Combinator's values, their focus on building real products rather than PowerPoint presentations, their bias toward action over planning, their emphasis on user focus over market sizing, all resonate with technical founders who might distrust traditional venture capital. This culture attracts a certain type of founder. People who want to build things rather than play business games. People who value substance over style. People who care about products and users more than press and hype. These founder characteristics correlate with building enduring companies rather than flashy startups that fade. Y Combinator's culture is both a filter and an attractant that shapes who applies and who succeeds. By 2014, Y Combinator has become so successful and influential that Paul Graham decides to step back from day-to-day operations. He's been running Y Combinator for 9 years. The organization has grown far beyond what he can personally manage. More importantly, he wants to write and think rather than operate. He appoints Sam Altman, the former Loopt founder who has been a Y Combinator partner since 2010, as the new president. Altman is 28 years old. Putting someone so young in charge of the most important early-stage investor in Silicon Valley is risky. But Graham believes Altman has the right combination of founder experience, intellectual horsepower, and ambition to take Y Combinator to the next level. Altman has been thinking deeply about Y Combinator's strategy. He has ideas about how to expand and evolve. Under Altman's leadership, Y Combinator grows aggressively. They increase batch sizes to 80+ companies. They start doing 2 batches per year in different locations. They launch Y Combinator Research, a non-profit research lab working on basic research and public goods. They create Y Combinator Continuity Fund to make growth stage investments in successful alumni companies. They dramatically expand the partner team. Altman also pushes Y Combinator to back more ambitious companies. He wants Y Combinator associated with companies tackling fundamental problems in energy, transportation, healthcare, and infrastructure, not just consumer software. This shift reflects his belief that technology should solve humanity's biggest challenges, not just make it easier to share photos or order food. He starts actively recruiting founders working on hard science and deep technology. This strategic evolution is controversial within Y Combinator. Some partners worry they're losing focus. The batch model works brilliantly for software companies that can iterate quickly and achieve product-market fit in months. But hard tech companies need years of research and development before they have products. They require far more capital. They face regulatory hurdles. The failure modes are different. Can Y Combinator's model work for companies building nuclear reactors or flying cars? Altman argues yes, with modifications. Hard tech companies still need the same founder qualities: technical brilliance, deep domain knowledge, unreasonable persistence. And they need help with the same challenges: fundraising, hiring, strategy, go-to-market. Y Combinator can provide value even if the timeline is longer. More importantly, Altman believes hard tech is where the biggest opportunities are. Software is becoming commoditized. The marginal returns on another social app or productivity tool are diminishing. The future belongs to companies solving physical world problems. This thesis leads Y Combinator to back companies like Cruise, working on self-driving cars; Rigetti, building quantum computers; Boom, developing supersonic passenger aircraft; Helion, pursuing nuclear fusion. These companies look nothing like traditional Y Combinator startups. They're capital-intensive. They require deep physics and engineering expertise. They face massive regulatory challenges. But they have huge potential impact if they succeed. The hard tech push produces mixed results. Some companies like Cruise succeed spectacularly. Cruise is acquired by General Motors for over $1 billion in 2016. Y Combinator's early investment returns many times over. But many hard tech companies struggle. The timelines are longer than expected. The capital requirements exceed what Y Combinator can provide. Some fail entirely when the technology doesn't work or the market isn't ready. By 2019, Y Combinator has backed over 2,000 companies. The portfolio includes 12 companies valued over $1 billion. Airbnb, Stripe, Coinbase, DoorDash, Instacart, Cruise, Dropbox, and others. Hundreds more are worth tens or hundreds of millions. The combined valuation of Y Combinator companies exceeds $200 billion. Y Combinator has become one of the most successful investors in history despite investing only tens of thousands of dollars per company initially. This success creates new challenges. Y Combinator is now so prestigious that founders feel pressure to get accepted at any cost. Some lie on applications. Others copy whatever they think Y Combinator wants to hear. The selection process becomes harder as applicants become more sophisticated at gaming it. Y Combinator has to constantly evolve their evaluation to identify authentic founder qualities versus performative ones. The alumni network also becomes harder to manage as it grows. With over 2,000 companies, maintaining culture and quality of connection becomes challenging. Y Combinator starts organizing regional events, creating specialized forums for companies at similar stages, and building software platforms for alumni communication. But something intangible is lost as the community scales. The intimacy of the early batches, when every founder knew every other founder, is impossible to recreate at this size. Demo Day faces similar scaling challenges. With 80 companies presenting, investors can't possibly evaluate all of them thoughtfully. The event becomes overwhelming. Investors develop strategies to pre-screen companies before Demo Day. Some skip demo day entirely and just meet companies they've identified through back channels. The format that worked brilliantly with 8 companies is straining at 80. Y Combinator experiments with solutions. They try splitting demo day into multiple sessions. They create better filtering tools for investors. They provide more detailed information about companies in advance. But fundamentally, they're trying to maintain an intimate, high-touch experience while operating at industrial scale. It's not clear if this is possible. In 2019, Sam Altman steps down as president of Y Combinator to focus on OpenAI, an artificial intelligence research company he's leading. Y Combinator appoints Jeff Ralston, a partner since 2011 and former founder of Rocketmail, which became Yahoo Mail, as the new president. This transition is smoother than when Graham handed off to Altman. Y Combinator now has institutional processes and a deep partner bench. It's less dependent on any single leader. Under Ralston, Y Combinator focuses on operational excellence rather than dramatic expansion. They refine the batch experience. They improve partner training. They strengthen alumni support. They professionalize fundraising for the main fund and continuity fund. The goal is sustainable quality rather than relentless growth. This marks Y Combinator's maturation from startup to institution. The COVID-19 pandemic in 2020 forces Y Combinator to adapt quickly. They move the entire batch online. Office hours happen over video. Dinners are virtual. Demo day is streamed. This is traumatic for an organization built on in-person interaction. Much of Y Combinator's magic comes from founders living near each other, running into each other constantly, forming deep bonds. Can that happen over Zoom? The answer is partially yes. Some aspects work better online. Founders can attend from anywhere in the world. They save time not commuting. They can focus more on building their companies. But other aspects suffer. The spontaneous conversations that lead to partnerships don't happen. The emotional support that comes from physical presence is diminished. The energy of demo day is lost when it's a webcast instead of a room full of people. Y Combinator decides to keep some remote elements even after the pandemic. They accept more international founders who participate remotely. They record talks so founders can watch asynchronously. They use technology to facilitate connection more efficiently. But they bring back in-person components for those who can attend. The hybrid model combines the reach of remote with the depth of in-person. In 2021, several Y Combinator companies go public in spectacular fashion. Airbnb's IPO values the company at over $100 billion. DoorDash goes public at $60 billion. Coinbase direct listing values it at $85 billion. These 3 companies alone create over $240 billion in public market value. Y Combinator's small early stakes are now worth billions. These outcomes validate everything Y Combinator has built. They prove that tiny initial investments in exceptional founders can generate world-changing companies and extraordinary returns. They demonstrate that the batch model, peer learning, and operational support create real value beyond capital. And they show that focusing on founder quality rather than business plans or markets is the right strategy for early-stage investing. The public market success also creates new challenges for Y Combinator. Later-stage investors now want access to Y Combinator companies earlier. They offer to invest at high valuations before demo day. This creates difficult dynamics. Should Y Combinator companies take these offers and skip the fundraising process? Or should they follow the traditional path and raise from multiple investors at demo day? Y Combinator's advice is nuanced. If the offer is from a high-quality investor at a fair price, taking it makes sense. It saves time and creates a strong partnership. But founders should be wary of preemptive offers designed to prevent price discovery. Some investors offer attractive terms before demo day precisely to avoid competing with others who might offer better terms after. Founders need to understand these dynamics and make informed decisions. The continuing fund Y Combinator launch becomes increasingly important. As Y Combinator companies succeed and raise subsequent rounds at high valuations, Y Combinator's ownership gets diluted. The Continuity Fund allows Y Combinator to invest more capital in winners to maintain ownership. This is crucial for capturing the full value of companies like Stripe and Coinbase that become extremely valuable over time. Without follow-on investments, Y Combinator's economic interest in these companies would be minimal despite their early crucial support. By 2022, Y Combinator has backed over 4,000 companies across nearly 50 batches. The combined valuation exceeds $600 billion. More than 40 Y Combinator companies are valued over $1 billion. Hundreds more are worth hundreds of millions. Y Combinator has invested in more unicorns than any other early-stage investor by a large margin. The model has proven durable across economic cycles, technology shifts, and leadership changes. What explains this sustained success over 17 years? Looking back at Y Combinator's history reveals several key factors that created and maintained their competitive advantage. First, they were early to recognize and exploit a major market dislocation. In 2005, the cost of starting a technology company had dropped dramatically, but venture capital hadn't adjusted. Y Combinator built a model optimized for this new reality. They provided exactly what founders needed at the earliest stage: small amounts of capital, tactical advice, peer support, and investor connections. This product-market fit for early-stage investing gave them years of advantage before others copied the model. Second, they built a brand and platform that created self-reinforcing network effects. As Y Combinator became prestigious, better founders applied. This allowed more selective admission. Higher-quality founders built better companies. These success stories strengthened Y Combinator's reputation. This attracted even better founders. The virtuous cycle compounded over 17 years until Y Combinator became the default choice for ambitious technical founders globally. Third, they systematically captured and transferred knowledge across batches. Every batch generated lessons about what works in early-stage companies. Y Combinator codified these lessons through essays, talks, office hours, and eventually software platforms. They made this knowledge accessible to all future batches. This created a learning organization that got smarter over time. Later batches benefited from accumulated wisdom of thousands of previous companies. This is similar to how Toyota's production system improved over decades as they captured and systematized knowledge. Fourth, they maintained focus on founder quality over everything else. While other investors got distracted by market size or technical novelty, Y Combinator kept asking the same questions. Is this person exceptional? Do they understand their users deeply? Can they build products quickly? Will they persist through setbacks? This focus on fundamentals proved more predictive of success than sophisticated market analysis or technology evaluation. And it gave them consistency across different eras and market conditions. Fifth, they built a culture that resonated with technical founders. Y Combinator's values, their emphasis on building rather than talking, their skepticism of conventional wisdom, their bias toward action, all attracted founders who cared about craft and substance. This cultural fit created better relationships and more successful outcomes. Founders who aligned with Y Combinator's values were more likely to take advice and more likely to pay it forward to future batches. Sixth, they were willing to look foolish and back ideas that sounded crazy. Airbnb, renting air mattresses to strangers. Stripe, another payment company when PayPal existed. Coinbase, Bitcoin exchange when Bitcoin was worth dollars, not thousands. Twitch, watching other people play video games. These all seemed absurd initially. Y Combinator backed them because they believed in the founders. This willingness to trust founders over market consensus generated many of their best investments. Seventh, they scaled thoughtfully. Y Combinator grew from 8 companies per batch to over 80 over 15 years. That's 10 times growth but spread over a long period. They added infrastructure, partners, and processes gradually. They didn't try to jump from 8 to 80 immediately. This patient scaling preserved culture and quality while capturing growth. Other accelerators that tried to scale faster often lost the magic that made them valuable. Eighth, they built continuity mechanisms that maintained relationships beyond the 3-month batch. The alumni network, the demo days, the online forums, the follow-on investments through the Continuity Fund, all created reasons for ongoing engagement. Y Combinator didn't view companies as transactions that ended at demo day. They invested in long-term relationships. This created loyalty and network effects that compounded over time. Ninth, they attracted and developed exceptional partners. Y Combinator's partners are nearly all former founders with operating experience. They lived through the struggles founders face. They have credibility and empathy that pure investors lack. And they're selected for ability to teach and transfer knowledge, not just pattern recognition. This partner quality is crucial to Y Combinator's model. Without great partners, the advice and support wouldn't create value. 10th, they got lucky repeatedly. Reddit's early success. Dropbox explosive growth. Airbnb surviving near death in 2009. Stripe becoming payment infrastructure for the internet. Coinbase riding the cryptocurrency wave. These outcomes weren't predetermined. They required luck in addition to skill. Y Combinator's model increased the surface area for luck by making many small bets. But luck still mattered enormously. The question for Y Combinator's third decade is whether these advantages remain durable. Several challenges threaten their continued dominance. First, the model has been widely copied. Hundreds of accelerators now exist globally. Many follow Y Combinator's playbook. Small investments, batch model, demo day, alumni network. This commoditizes what used to be unique. Y Combinator still has brand advantage and network effects, but the gap has narrowed. Founders now have alternatives that didn't exist in 2005. Second, the cost of starting a company keeps falling. With tools like GitHub Copilot and GPT models, solo founders can build sophisticated products quickly. This democratizes startup creation but also floods the market. Y Combinator faces more competition for founder attention and must evaluate more applications to find the same number of exceptional founders. The signal-to-noise ratio is degrading. Third, the most successful Y Combinator companies are now competitive threats. Stripe, Instacart, DoorDash, Coinbase, these companies hire aggressively. They offer compelling opportunities for talented people. Some potential founders join these companies as employees rather than starting their own. Y Combinator's own success creates alternatives to Y Combinator. Fourth, the alumni network becomes harder to leverage as it scales. With over 4,000 companies, coordinating help and maintaining culture is challenging. The early batches had tight bonds because everyone knew everyone. That's impossible at current scale. Y Combinator needs new mechanisms to capture network value as the network grows. It's not obvious what these should be. Fifth, the hard tech bet hasn't fully paid off yet. Companies like Helion, Boom, and many others have consumed enormous capital and time without generating returns. If these don't succeed, Y Combinator may need to rethink their strategy. Software created most of their value historically. Expanding beyond software is risky and unproven. Sixth, regulatory and political pressure on technology companies is increasing. Governments worldwide are scrutinizing platform power, data practices, content moderation, and market dominance. Some Y Combinator companies like Airbnb and Coinbase face existential regulatory threats. If regulation stifles innovation, Y Combinator's model may generate lower returns. They need strategies for navigating increasing political risk. Seventh, the public market exits of 2021 may have been a high water mark. As interest rates rise and growth stocks fall, exit valuations are declining. Companies that would have gone public at high valuations are staying private longer or accepting lower prices. This affects Y Combinator's returns directly. Their portfolio value is tied to exit multiples. A sustained bear market for technology stocks reduces returns. Despite these challenges, Y Combinator enters its third decade from a position of strength. They have deep capital from successful exits. They have global brand recognition. They have an alumni network of thousands of founders. They have institutional knowledge from working with over 4,000 companies. and they have a model that has proven adaptable across different eras and technologies. The fundamental bet that drives Y Combinator remains sound. Exceptional founders will always exist. These founders need help, advice, and connections when they're starting. Providing this at scale, systematically, creates value. As long as Y Combinator maintains quality in selection and support, they should continue generating strong returns and impact. Looking at Y Combinator's history reveals universal lessons about early-stage investing that apply beyond their specific model. Lesson 1: Founder quality predicts success better than business plans or market analysis. Y Combinator's obsessive focus on founders rather than ideas has proven correct repeatedly. The best founders figure out what to build through iteration and user feedback. Mediocre founders fail even with great initial ideas. Evaluating human qualities like determination, learning speed, and user empathy is more important than evaluating business models. This is hard for traditional investors to accept. Business school trains people to analyze markets, competition, and financial projections. But early-stage companies change so much that these analyses are mostly fiction. The only constant is the founders. Betting on people over plans requires different skills. You need to assess character, capability, and chemistry. This is more art than science. Y Combinator developed this art through repeated practice across thousands of companies. The implication for investors is clear. Spend more time understanding founders and less time on market sizing and financial models. Ask questions that reveal how founders think, not what they plan to do. Test their self-awareness, flexibility, and determination. Look for evidence of exceptional ability in any domain. Great founders have often achieved something remarkable before their startup, even if unrelated. This demonstrates the drive and capability needed to build companies. Lesson 2: Small early investments in exceptional companies generate better returns than large later investments in good companies. Y Combinator's model proves that ownership percentage matters more than absolute dollars invested. Investing $20,000 for 6% beats investing $10 million for 10% if the company becomes very valuable. Early-stage investing is about finding companies that can increase value 1,000 times or more. At those multiples, entry price and ownership trump check size. This contradicts conventional venture capital wisdom that you need large funds and big checks to generate meaningful returns. Y Combinator shows that many small early bets can outperform fewer large late bets. The key is having strong selection and getting access to companies when they are cheap. If you can consistently identify future unicorns at seed stage, you don't need to write $10 million checks. You can create a huge portfolio with small initial investments. The challenge is most investors can't identify winners early. They lack Y Combinator's selection advantage. So they invest later when outcomes are more obvious but valuations are higher. This is rational given their constraints. But it's less lucrative. The lesson is if you can build selection capability, early-stage investing offers superior returns per dollar invested. Lesson 3: Peer learning and network effects create value beyond capital and advice. Y Combinator's batch model generates benefits that individual investments can't capture. When 40 founders are struggling with similar problems simultaneously, they help each other. This collective problem-solving is more valuable than any single advisor's input. It's also more scalable. One partner can support 10 companies in a batch because the companies support each other. This insight applies beyond Y Combinator. Any investment structure that facilitates peer connection and knowledge sharing will generate better outcomes than isolated investing. The challenge is creating authentic community. Founders need to trust each other enough to share real problems and failures. This requires shared experience, repeated interaction, and cultural alignment. Y Combinator built this through the intensity of the 3-month batch. Other models need different mechanisms, but the principle holds. The implication is investors should facilitate founder community, not just provide capital and advice. Create forums for peer learning. Introduce portfolio companies to each other. Organize events that build relationships. Measure success not just by individual company outcomes but by strength of network. This longer-term view builds more sustainable competitive advantage. Lesson 4. Brand and platform create compounding advantages over time. Y Combinator's reputation now does much of the work in attracting great founders. They don't need to convince people that Y Combinator is valuable. Everyone already believes it. This brand allows them to be highly selective, which maintains quality, which strengthens the brand. This virtuous cycle is incredibly powerful but takes many years to build. The lesson for investors is that reputation matters enormously in early-stage investing. Founders choose investors based on who they think will be most helpful and most prestigious. If you build a reputation for adding value and backing winners, founders seek you out. This gives you better selection and better terms. But reputation takes consistent performance over many years. There are no shortcuts. The implication is to invest in thought leadership and visibility. Write about what you're learning. Share insights publicly. Be generous with advice to founders whether or not you invest. Build reputation as someone who understands startups deeply and supports founders genuinely. This long-term brand building pays dividends that exceed any single investment. Lesson 5. Focus and consistency beat sophistication and cleverness. Y Combinator has asked fundamentally the same questions for 17 years. Are these founders exceptional? Are they solving a real problem? Can they build products quickly? Will they learn and adapt? This simplicity is powerful. They didn't get distracted by hot sectors or new investment themes. They stuck to their core belief that great founders building real products succeed regardless of market conditions or technology trends. Many investors change strategies constantly, chasing whatever is currently working. They invest in social media when that's hot, then pivot to crypto, then to artificial intelligence. This opportunism rarely works. By the time something is obviously hot, it's usually crowded and expensive. Y Combinator's consistency allowed them to back great companies across different sectors and technologies without chasing fads. The lesson is to develop a clear investment thesis based on durable insights, then execute consistently for years. Don't get distracted by short-term trends. Don't change strategies based on recent failures or successes. Trust that if your selection framework is sound, it will work across different environments. This requires patience and conviction that most investors lack. Lesson 6. Helping founders avoid common mistakes creates as much value as identifying opportunities. Much of Y Combinator's advice is about what not to do. Don't raise too much money too early. Don't hire too fast. Don't build features users don't want. Don't ignore metrics. Don't avoid hard conversations. This negative knowledge, accumulated from watching thousands of companies make mistakes, is incredibly valuable. Founders, especially first-time founders, don't know what they don't know. They're likely to make predictable mistakes. An investor who can warn them about these mistakes and explain why they matter saves the founder years of pain. This error prevention is often more valuable than strategic advice about what to do. Knowing what not to do eliminates paths that waste time and resources. The implication for investors is to systematically capture lessons from failures. When portfolio companies struggle, document what went wrong and why. Build a library of common failure modes. Share these proactively with new companies. This institutional knowledge about failure is a major source of value. Most investors focus only on success stories. Learning from failures creates differentiated insight. Lesson 7. Timing and luck matter more than most people admit. Y Combinator benefited enormously from starting when they did. The cost of startups had just dropped, but venture capital hadn't adjusted. This created an opportunity window. If they had started 5 years earlier, the economics wouldn't work. 5 years later, they'd face more competition. They got the timing right. Similarly, many of their best investments involved lucky timing. Airbnb survived because Sequoia took a chance during the financial crisis. Coinbase benefited from Bitcoin's rise. Stripe grew with the shift to online commerce. Acknowledging luck doesn't diminish Y Combinator's achievement. They created a model that increased surface area for luck. By making many small bets, they ensured they'd benefit when unexpected opportunities emerged. But they were also fortunate. Other equally smart people with similar models but worse timing or luck didn't succeed as well. This is important to remember. Success stories tend to over-attribute outcomes to skill and under-attribute to luck. The lesson for investors is to be humble about your own success. Recognize when you've been lucky. Don't assume your model will work in all environments. Be prepared to adapt when conditions change. And don't judge others too harshly for failures that may reflect bad luck rather than bad decisions. The margin between success and failure in early-stage investing is often narrower than it appears. Lesson 8: Culture and values can't be separated from strategy. Y Combinator's focus on builders over talkers, products over presentations, substance over style isn't just cultural preference. It's strategic. This culture attracts technical founders who care about craft. These founders build better products. Better products create more value. Culture drives outcomes. Y Combinator understood this from the beginning. Paul Graham's essays articulated values that resonated with technical people. This wasn't marketing. It was authentic expression of what Y Combinator believed. But it had strategic benefits. It created selection bias toward founders Y Combinator could help most. Many investors try to copy Y Combinator's model without the culture. They create accelerators with batches and demo days but without genuine founder focus. These superficial copies don't work as well. Founders sense inauthenticity. The best founders choose investors who share their values. This is why culture matters strategically. It's a filter and attractant that shapes who you work with. The lesson is to be clear about your values and let them guide strategy. Don't adopt values because they're popular. Articulate what you genuinely believe about how companies should be built. This authenticity will attract founders who share those beliefs. These cultural matches produce better relationships and outcomes. Forcing cultural fit through incentives or rules doesn't work. It has to be real. Lesson 9: The ability to say no is as important as knowing when to say yes. Y Combinator rejects over 97% of applicants. This extreme selectivity is crucial to their model. Every company they accept represents opportunity cost. If they accept mediocre companies, they dilute partner attention, weaken the batch peer effects, and damage their brand. The discipline to pass on companies that are good but not exceptional separates great investors from average ones. This is psychologically difficult. Investors naturally want to make more investments. Every pitch triggers pattern matching that finds reasons to say yes. Maybe this could work. Maybe we're wrong to be skeptical. Maybe we'll regret passing. This optimism bias causes investors to accept too many marginal opportunities. Y Combinator fights this by having clear standards and trusting their frameworks. If a founder doesn't demonstrate exceptional qualities in the application and interview, they pass. No exceptions for friends, no benefit of the doubt for interesting ideas with mediocre founders. The implication for investors is to be ruthlessly selective. Set high standards and enforce them consistently. Don't invest because you're afraid of missing out. Don't invest because you like the founders personally. Invest only when you see clear evidence of exceptional capability and fit with your model. The companies you don't invest in matter as much as the ones you do. Poor investments consume time, damage reputation, and crowd out better opportunities. Lesson 10: Transparency and intellectual honesty accelerate learning. Y Combinator's willingness to share what they've learned through essays, talks, and public discussions is unusual for investors. Most firms guard their insights as proprietary. Y Combinator does the opposite. Paul Graham's essays explain their investment philosophy in detail. Partners give talks sharing specific advice. They're remarkably open about what works and what doesn't. This transparency seems to contradict competitive advantage. If everyone knows Y Combinator's selection criteria and methods, can't they be copied? The answer is yes and no. The frameworks can be copied but the execution cannot. Reading about how Y Combinator evaluates founders doesn't make you as good at it. that requires practice across thousands of companies. More importantly, Y Combinator benefits from sharing. Their transparency attracts founders who value intellectual honesty. It builds their reputation as thought leaders. It creates goodwill in the startup community. And it forces internal clarity. When you explain your thinking publicly, you must understand it clearly yourself. The lesson is to share what you learn. Write about your investment philosophy. Explain your failures and what they taught you. Be intellectually honest about what you know and don't know. This transparency builds trust and reputation. It also makes you a better investor. The discipline of articulating your thinking reveals gaps and inconsistencies. Public accountability forces you to be rigorous. Lesson 11: Diversification through many small bets beats concentration on few large bets at early stages. Y Combinator's model of backing 40 to 80 companies per batch with small investments is essentially a diversification strategy. They know most startups fail. They can't predict which ones will succeed. So they make many bets, knowing a few huge winners will return the fund. This portfolio approach is rational given the unpredictability of early-stage outcomes. Traditional venture capital often concentrates capital in fewer companies with larger checks. This makes sense for later-stage investing when outcomes are more predictable. But at seed stage, concentration is risky. The information available is too limited to distinguish winners reliably. Y Combinator's high-volume approach accepts this uncertainty. They're not trying to be right about every company. They're trying to ensure they own pieces of the few that become extremely valuable. The implication is that investment strategy should match stage. Early-stage investors should diversify broadly. Later-stage investors can concentrate on fewer high-conviction bets. Trying to pick winners from 20 applications and invest heavily in just 3 is likely to miss the best opportunities. Better to invest modestly in 15 and let performance data reveal which deserve more capital. This sequential approach uses time and data to inform concentration decisions rather than relying solely on initial judgment. Lesson 12: The best ideas often look bad initially. Y Combinator has repeatedly backed companies that seemed crazy to most observers. This willingness to support contrarian ideas is crucial to their success. The best opportunities usually aren't obvious. If everyone agrees something is a great idea, it's probably too late to generate outsized returns. Competition drives valuations up and returns down. The massive wins come from seeing value others miss. This requires intellectual independence and courage. When Paul Graham backed Airbnb despite thinking the idea sounded terrible, he was trusting the founders over the market opportunity. When they backed Stripe as another payments company competing with PayPal, they were betting on founder quality over market consensus. These decisions felt uncomfortable. That discomfort is often a signal. If an investment feels completely safe and obvious, it's probably not a great opportunity. The lesson is to seek ideas that seem bad but have hidden strengths. Look for smart founders pursuing ideas that others dismiss. Ask why the consensus is wrong rather than assuming it's right. Develop conviction in non-obvious opportunities. This is easier said than done. Humans are social animals who trust consensus. Going against the crowd triggers anxiety. But in investing, consensus is often wrong at extremes. The ability to trust your analysis over market sentiment is essential. Lesson 13: Speed and decisiveness create advantages in competitive markets. Y Combinator's application to demo day to funding cycle happens in 3 months. This compressed timeline forces rapid evaluation and decision-making. It also creates urgency for founders. They can't procrastinate on hard decisions. They must build products, talk to users, and show progress quickly. This pace filters for bias toward action over analysis paralysis. The 3-month timeline also benefits Y Combinator competitively. Founders who need capital quickly choose Y Combinator over slower alternatives. The batch deadlines create natural urgency that accelerates decisions on both sides. And the demo day platform compresses fundraising from months to weeks. This speed benefits founders who want to get back to building rather than spending 6 months fundraising. The lesson is that process speed is a competitive advantage in early-stage investing. Long due diligence processes select for patient founders but filter out impatient builders who want to move quickly. If you can evaluate and decide faster without sacrificing quality, you'll win deals against slower competitors. This requires confidence in your frameworks and willingness to decide with incomplete information. Risk-averse investors who need certainty can't move fast. Comfortable with uncertainty enables speed. Lesson 14: Geography matters less than most people think but more than Y Combinator initially believed. Y Combinator started in Cambridge, moved to Mountain View, and now supports founders globally. This evolution reflects changing views on geographic importance. In 2005, being in Silicon Valley seemed essential. Access to talent, capital, and customers was concentrated there. By 2020, remote work and global communication reduced these advantages. Great founders and companies can emerge anywhere. However, Y Combinator still brings most founders to the Bay Area for the batch. They recognize that in-person interaction creates value that remote cannot fully replicate. The casual conversations, spontaneous collaborations, and relationship depth require physical proximity. The hybrid model, with remote participation available but in-person encouraged, reflects this nuanced view. Geography matters for community building even as it matters less for company building. The lesson is to be flexible about geography without ignoring its benefits. Accept that great founders exist globally and structure investments to access them. But create opportunities for physical gathering when possible. The deepest relationships and most valuable networks form through repeated in-person interaction. This doesn't require everyone to live in the same city permanently. But it does benefit from periodic intensive time together, like Y Combinator's 3-month batches. Lesson 15: Long-term thinking requires short-term sustainability. Y Combinator's model works because the economics are sustainable. The small initial investments return enough from successful companies to fund operations and future batches. This allows patient capital deployment. They are not pressured to force exits or push companies to scale prematurely. The structure aligns their interests with founders' interests in building enduring companies. Many accelerators have failed because they couldn't achieve economic sustainability. They raised funds to invest in startups but didn't generate returns sufficient to continue operating. This forced them to shut down or drastically change models. Y Combinator avoided this by keeping costs low initially, achieving success early with Reddit and others, and reinvesting returns into growing the operation. They never became dependent on outside capital to survive. The lesson is that investment models must be economically sustainable to support long-term orientation. If your structure requires continuous outside funding, you're vulnerable to changing market conditions or investor sentiment. If you can achieve self-sufficiency through returns from investments, you gain independence and patience. This doesn't mean avoiding outside capital entirely. Y Combinator now manages capital from limited partners. But they built sustainability first, which gave them negotiating power and strategic flexibility. Y Combinator's story is ultimately about seeing opportunity where others saw obstacles. In 2005, the conventional wisdom was early-stage investing didn't work at small scale. The economics required large checks and concentrated portfolios. Paul Graham saw this differently. He recognized that changing technology economics created opportunity for a new model. Small checks, many bets, systematic support, peer learning. This contrarian vision proved correct. The deeper insight is that Y Combinator succeeded by aligning their model with founder needs rather than investor preferences. Traditional venture capital was structured for investor convenience. Large funds needed large deals to deploy capital efficiently. Due diligence processes minimized investor risk. Portfolio sizes were limited by partner bandwidth. Y Combinator flipped this. They designed for what founders needed at the earliest stage. Modest capital, practical advice, peer support, fast decisions. This founder-centric design created value that translated into investor returns. This is a profound lesson about innovation in any field. Incumbents optimize their models over time for their own convenience and economics. This creates opportunities for new entrants who optimize for customer needs instead. Y Combinator didn't try to compete with Sequoia and Kleiner Perkins on their terms. They created a different game focused on a different stage with different economics. This category creation avoided direct competition while capturing enormous value. Looking at Y Combinator in 2023, the organization faces an uncertain future despite past success. The accelerator model has been widely copied. Dozens of Y Combinator alumni have started their own funds and accelerators. The playbook is well known. This commoditization threatens Y Combinator's differentiation. If everyone does batches with demo days and small checks, what makes Y Combinator special? The answer is their accumulated advantages. Brand reputation, alumni network, pattern recognition capability, and capital resources create durable moats. But these require active maintenance. Brand can erode if quality declines. Networks become less valuable as they scale beyond connection capacity. Pattern recognition must evolve as startup best practices change. Capital advantages diminish if others raise larger funds. Y Combinator must continue innovating to maintain leadership. The hard tech bet represents one attempt at innovation. By backing companies working on nuclear fusion, supersonic flight, and life extension, Y Combinator is expanding beyond software. This is strategically sound. Software returns are likely declining as the sector matures. Physical world problems may offer the next frontier for venture-scale returns. But hard tech requires different skills and longer time horizons. It's not clear why Combinator's model translates effectively. Another strategic question is geographic expansion. Should Y Combinator create regional hubs in Europe, Asia, and Latin America? This could tap broader founder pools and local opportunities. But it risks fragmenting culture and diluting partner attention. The magic of Y Combinator comes partly from concentration. Spreading too thin might destroy what makes it work. The right answer likely involves selective expansion focused on maintaining quality over maximizing reach. A third question is vertical specialization. Should Y Combinator create specialized tracks for crypto, climate, healthcare, or other domains? Specialist partners with deep domain expertise could add more value than generalists. But specialization risks missing cross-domain opportunities and creating silos. Y Combinator's strength has been generalist pattern recognition about founders and startups, not domain expertise. Specialization might undermine this advantage even as it creates new value. The answers to these strategic questions will determine whether Y Combinator remains dominant or becomes one of many strong early-stage investors. The organization has resources, reputation, and capabilities to succeed. But continued success is not guaranteed. Technology markets are dynamic and competitive. Models that work brilliantly in one era can become obsolete quickly. Y Combinator must evolve while preserving what makes them special. This balance between innovation and consistency is the central challenge. One thing seems certain. Y Combinator's impact on startup culture and early-stage investing is permanent. They prove that systematic, scaled support for early-stage founders creates enormous value. They demonstrated that small investments in great founders at idea stage can generate spectacular returns. They showed that community and peer learning amplify individual advice. They established that founder quality matters more than business plans. These insights are now conventional wisdom. Every accelerator, angel investor, and seed fund has adopted elements of Y Combinator's approach. More broadly, Y Combinator influenced how startups are built. The focus on talking to users and iterating rapidly. The emphasis on building products rather than writing business plans. The preference for technical founders over professional managers. The skepticism toward conventional wisdom and embrace of contrarian ideas. These cultural values, spread through Y Combinator's essays and alumni, shaped a generation of founders. The way startups operate today reflects Y Combinator's influence even when founders haven't gone through the program. Y Combinator also changed the power dynamics between founders and investors. By providing an alternative to traditional venture capital, they gave founders more leverage. Founders could raise small amounts from Y Combinator, build traction, then negotiate with VCs from strength. This shifted the balance of power. VCs had to offer better terms and treatment to win competitive deals. The entire early-stage ecosystem became more founder-friendly, partly because Y Combinator created competition for founder access. The downstream effects extend further. Y Combinator companies employed hundreds of thousands of people. Airbnb hosts earned billions in supplemental income. Stripe enabled millions of businesses to accept payments online. DoorDash provided income to delivery workers during the pandemic. Coinbase gave millions access to cryptocurrency. These companies created economic opportunity and value far beyond what Y Combinator captured. The social impact, for good and ill, is enormous. The negative consequences deserve acknowledgement too. Some Y Combinator companies have harmed workers, disrupted communities, and concentrated wealth. The gig economy model that Uber, DoorDash, and Instacart pioneered, partially through Y Combinator, has been criticized for exploiting workers with low pay and no benefits. Airbnb's success has contributed to housing shortages in some cities as landlords convert long-term rentals to short-term vacation properties. Cryptocurrency, which Coinbase helped mainstream, has enabled scams, environmental damage through energy-intensive mining, and financial speculation that enriches early adopters at the expense of later entrants. Y Combinator would argue these critiques miss the bigger picture. Technology creates disruption but also enormous benefits. The net effect is positive even if individuals are harmed. The gig economy provides flexible income opportunities that wouldn't exist otherwise. Airbnb allows homeowners to monetize unused space and gives travelers more affordable options. Cryptocurrency creates financial access for people excluded from traditional banking. The innovation these companies enabled improves lives overall despite costs. This debate about technology's impact reflects broader questions about capitalism, innovation, and progress. Is the disruption worth the benefits? Who wins and who loses? What obligations do founders and investors have beyond maximizing returns? These are not easy questions. Y Combinator's story illuminates them without resolving them. The organization has created enormous wealth and economic value. Whether that translated to broad social benefit or concentrated gains for elites depends on your perspective. What's undeniable is that Y Combinator proved a new model for early-stage investing works. In 2005, the idea seemed crazy. Tiny investments in batches of companies with minimal due diligence and 3-month time frames. Every conventional investment principle said this shouldn't succeed. But it did because the model aligned with changing economics and founder needs. Paul Graham and his partners saw something others missed. They built an organization that captured that insight and scaled it globally. The story offers hope for future innovators. If you see a genuine opportunity that others dismiss, you might be right even if you're alone initially. If you design for customer needs rather than your own convenience, you can create value others can't. If you're willing to look foolish and back contrarian ideas, you might identify transformative opportunities. If you share what you learn and build authentic community, you can create network effects that compound over time. These principles aren't specific to Y Combinator. They apply broadly to anyone trying to build something new. Y Combinator also demonstrates that institutions can maintain culture and values while scaling. Many organizations lose their essence as they grow. Bureaucracy replaces entrepreneurship. Process replaces judgment. Politics replaces merit. Y Combinator avoided these traps by promoting from within, maintaining clear values, and keeping decision-making decentralized. Partners have autonomy to back companies they believe in. Founders have freedom to build as they see fit. This trust-based culture scales because it's based on principles rather than rules. The ultimate test of Y Combinator's model will be generational. Can they remain excellent through multiple leadership transitions? Paul Graham to Sam Altman to Jeff Ralston worked smoothly. But can it continue for decades? Will the 4th and 5th generation of leaders maintain quality and culture? Or will Y Combinator gradually regress to the mean as the founding vision fades and institutional inertia grows? This question won't be answered for years. But it's the central challenge for any organization that aspires to endure. For now, Y Combinator stands as one of the great success stories in venture capital history. From 8 companies and $48,000 in 2005 to over 4,000 companies and $600 billion in value created in 2023. From unknown experiment to global institution. From Paul Graham's living room to offices around the world. The journey has been remarkable. The impact has been profound. The lessons are valuable for anyone interested in entrepreneurship, investing, or innovation. The story is still being written. New batches launch twice a year. New founders are building new companies. Some will fail. A few will succeed spectacularly. The alumni network continues growing. The pattern recognition deepens. The brand strengthens. Y Combinator's third decade will bring new challenges and opportunities. How they adapt while staying true to their core principles will determine whether this success story continues or whether they become another case study in organizational decline. But regardless of what happens next, Y Combinator has already changed the world. They proved that small bets on great people generate extraordinary returns. They showed that systematic support for founders at scale creates value. They demonstrated that culture and values drive outcomes as much as strategy. They built an institution that will influence technology and entrepreneurship for generations. That achievement alone makes their story worth studying, understanding, and learning from. The essence of Y Combinator's success can be captured in a simple idea. Find exceptional people solving real problems. Give them modest capital, practical advice, and peer community. Get out of their way and let them build. Support them through struggles. Celebrate their success. Learn from their failures. Repeat. This formula seems obvious in retrospect. But in 2005, it was revolutionary. That's the nature of great innovation. It's obvious once someone proves it works. Before that, it's crazy. Paul Graham and his partners were willing to look crazy. They trusted their instinct over conventional wisdom. They built something new rather than copying what existed. They stayed focused on their core insight while being flexible on details. They created an organization that compounds value over time through network effects and knowledge accumulation. This is entrepreneurship at its finest. Seeing opportunity where others see obstacles. Building something valuable from nothing. Creating lasting impact through vision and execution. That's the story of Y Combinator. An experiment that became an institution. An idea that changed an industry. A model that proved small bets on great people can change the world. In 2005, Paul Graham asked what would happen if we invested tiny amounts in batches of startups and helped them intensively for 3 months. 2 decades later, we have the answer. You get Reddit, Dropbox, Airbnb, Stripe, Coinbase, DoorDash, Instacart, and thousands of other companies worth hundreds of billions of dollars collectively. You create jobs for hundreds of thousands of people. You enable millions of customers and users. You influence how an entire generation builds companies. You change what's possible. Not bad for an idea everyone thought was crazy.